really supported this market in face of big outflows from FIIs. And we have the largest domestic mutual fund, the top team of that actually now joining us, ICICI Prudential Mutual Fund. We have Naren and Nimesh Shah, the two top guys at the mutual fund with us. Good morning, gentlemen. First of all, Happy New Year to both of you and to your team. Naren, what's your sense? Because we've seen huge inflows from domestic investors. That's continued in face of FII outflows. Does that give you confidence about the market itself, that we'll not have too much of downside?
I think Nimesh is better responding to that question than me. I would request you to
Okay,
ask.
Nimesh, why don't you take that question?
In the sense that what is the alternative, where it is moving to? We keep on asking our distributors as to what is happening, will the flows continue? Because a lot of market depends on where the mutual fund local flows. I think November has been better than October, and December has continued with the numbers that we show. So we are having almost $3 billion of gross sales every month, out of which around 4,000 crores comes from SIPs. So it's a very steady flow. In February, even if you see February 2016, the retail investor in this country has matured. Even if you see February 2016, when the markets had reached 23,000, the flow has been steady since May 2014. Every month it is ranging between $2 to $3 billion. The gross sales is what you track to understand the sentiment. So I believe this range of which has reached $3 billion today, but on the lower side, I think $2 to $3 billion of flows, if you track the last 2.5 years, is continuing month on month. And talking to people in the market, you don't see any signs of that slowing down. January is better than December.
What about redemptions then? You said if you track the gross purchases, you're getting that sense. But say like February 2016 or Jan 2016 or the Trump month, November 8th through December 8th, the kind of fall we saw. How were redemptions behaving?
The good thing is there won't be redemptions if the market corrects. The Indian retail investor has matured, and there are no redemptions when the market corrects.
Okay.
There are redemptions, in fact, on the up. When the market goes up, there are redemptions. When the market goes down, the redemptions freeze.
Okay.
So that's a very steady thing for the market, that because of which we believe that flows can continue into the domestic space.
Okay, Naren, hi, morning. Happy New Year to you.
Same to you.
I wanted your thoughts on what to expect from the budget this time, because the government has very limited funds because of no gains from demonetization. How then should we expect a boost perhaps in capital spending?
See, actually, no. One of the lessons I learned from Richard Koo of Nomura was that everyone believes that government does not have money. But if corporates don't do capex and people are saving, government has to spend. Most people believe that US will get into trouble when their fiscal deficit went up. There were no problems. Japan has been having high fiscal deficits for more than a decade without problems. So when you don't have a domestic capex cycle, I believe the capacity of the government to have a public capex cycle is very, very high. And if you see the kind of increase in revenues that they have got in excise duty and customs duty, I believe that there are no serious problems to increase capex or fiscal spending. And the entire country needs more public capex at this point of time, when you don't have any private sector capex and when people are savings and interest rates are coming down.
Okay, Naren, but what's the market call from here? Because we have been quite stagnant. We've seen a lot of time consolidation or time correction for our market, even though individual stocks have done well. Do you see that kind of market from here on as well, where the index may not do much, but stocks will move on?
See, I think the big challenge is that, you are in neutral territory broadly. And when you are in neutral territory, you don't believe that you can make big money. There is no sign of panic. There is no sign of euphoria. So you're exactly in the middle. So what we as a house have done is that we have recommended our dynamic asset allocation funds, which are much more suited for neutral markets, because neither is the market cheap, neither is the market costly. And you are not able to make a case that you will make mega returns at this point of time in market. So we have actually bet on the dynamic asset allocation theme, because for 2 years actually we were trying to tell people fixed income was very attractive. But if you see the way interest rates have fallen, even that place doesn't look like you can make mega returns in fixed income from here. So that's why we have moved to the dynamic asset allocation category.
When you say dynamic asset allocation, what is the choices in terms of valuations, or is it in terms of expected earnings growth?
See, what we have seen is that earnings growth, keeps changing, and that's why we have moved much more to a price to book kind of model.
Okay.
Because otherwise, if you go back and look at earnings at the beginning of the year, everyone expected 15 to 20%
Exactly.
earning. Now it has come down to 3 to 4%. What we have seen over a period of time is that earnings is much more unstable, whereas something like price to book works much better, and that's what we have found to be much more rewarding for long-term investors.
Okay, before I go back to Nimesh, I just want to finish that argument on the budget as well. You said that you expect an increase in revenues from excise and customs duties, and that perhaps can boost spending. Do you think the government has enough largesse to even offer meaningful income tax rebates to boost consumption? Because that is also one expectation.
See, clearly I think government will give some income tax rebates, and clearly if compliance improves, and there if you see the numbers which have come for some of the tax collections, they've been pretty good. So I believe that as the level of compliance in the economy increases, there is scope for direct taxes to come down. And I believe that the government will give some rebates in direct taxes. I think the way the government has handled the entire oil side over the last 2 years has been particularly commendable, because what was leaking at the with a huge subsidy about 2 to 3 years back has been converted to an area which is responsible for good excise collections. So I believe that the problems on the fiscal side, particularly on the center side, is overstated at this point of time. Having said that, we don't know much about GST, how that will affect both state and center. But I would say that we are easily in a very comfortable position on the central FIS side at this point of time.
Okay, yes, but the states are now becoming important actors. We have lots of questions for you on how the budget might boost consumption and how rate cuts might boost consumption. We have to take a mandatory break. Back in a jiffy.
Welcome back to the show. We are in conversation with the top team at ICICI Prudential AMC. Nimesh Shah, the MD and CEO, and Naren, the Executive Director and CIO of the company, are both with us here. Nimesh, in the break you were telling us about how the market has not given you great returns over the last 2 years, but this dynamic asset allocation fund has given you, almost about 9 to 10% returns. Just flesh that topic out for us, for a long-term investor.
See what is happening. Markets, the maximum inflows in mutual funds come when the markets are relatively higher, right? So if we have to get consistent flows, what we should do, we should sell minimum negative experiences, because people come in when there is euphoria. So as soon as the markets went up around October 2014, we started promoting a product which is called ICICI Prudential Balance Advantage Fund, which actually allocates equity instead of remaining completely invested all the time. It fluctuates equity allocation from 30% to 80%. So when the markets, based on the price to book ratio, if the markets are expensive, we get into debt. And as the market keeps on going down, at every price to book ratio, you are buying. And as the market goes up, you are selling. So you are counter-cyclical. So the Indian investor will remain, we believe, will remain pro-cyclical. But money can be made if you are counter-cyclical. So this is done by the products. It's a fantastic retail product where I believe this category is very good for the retail investor, because psychologically he will come only after past returns are good, the time when he should not be coming in, right? So psychologically it's India will remain, inflows will remain when the markets are very high. So to protect the investor, this kind of counter-cyclical products is what we have been promoting in the last 2 years.
So do you assess the equity debt portfolio every month, every week?
Every day, at every price to book ratio, the dealer knows how much equity he has to keep.
Okay.
So if today the markets goes up, the dealer will be selling. And as the market gets correct, if the market goes down, the dealer will be buying, because he has to change the allocation every day.
Okay, I want to get to some sectoral preferences to Naren before we run out of time. Naren, if you are betting that this could be a low interest rate year, what are your bets? Will you be in consumption, or will you be in infrastructure, which perhaps will benefit on the fringes.
Clearly, two bets that we have is one is telecom.
Really?
In my funds, basically primarily because if you look at telecom, it's a sector which has done badly for 9 years. The aggregate market cap of all the telecom companies in India is lower than that of Indonesia. And so I believe that India is a much bigger country than Indonesia or Thailand or Malaysia. So the market caps of the leaders in many of the other countries are 10 times more than the Indian market cap. So we see that as a good long-term opportunity.
Okay.
Because while there is huge price war at this point of time, the necessity for telecom for each of us has only increased over the last 3 to 5 years. And that's why that's one area where we are very positive on. The second area is clearly anything connected to power. We believe that in the next 3 years, the existing power plants would get much more utilized. And clearly we see that every year 5 to 7% power demand increase without any new capacity coming in. So we believe in this entire power eco chain, which includes coal, which includes power generation, it includes power transmission. They should all do reasonably well over the next 3 years because the capacity is done and all you're going to see is increased utilization in the next 3 years. So these are two areas which we see as reasonably attractive. You have to remember that they have all done badly for almost a decade. So when you speak in 2017, many of those stocks are lower than where they were in 2007.
Okay. Well, I have just one worry which I want to ask you. The rupee has been unusually strong. I mean, it's moved actually with the dollar. It's parity with dollar, although dollar has strengthened so much. Would you worry? I mean, what are your FII friends telling you? Are they willing to buy when the rupee is so expensive for fear that there might be a depreciation around the corner?
I don't know, FIs have been selling, but our internal models make us feel that some amount of depreciation is healthy for corporate India, given that if you're going to have such a strong currency, it is going to affect earnings. So, yeah, me and my colleagues believe that some amount of depreciation is going to benefit the corporate sector and may benefit markets because Indian currency has been unusually stable.
Okay, well, we have completely run out of time. We would have loved to chat some more, but we will after we end the show. We'll chat offline as well. Thank you so much for joining us and giving us your view on 2017. You will see excerpts of this very interesting interview through the course of the day. But with this, it's curtains down on Bazaar.